Hello students, welcome back. This is Mrs. Mercado speaking. I hope all of you are doing well. In this particular lecture, I am going to be going over some of the content in Chapter 9, which deals with long-term assets, fixed and intangible. This is Accounting 2401, Principles of Financial Accounting. In this chapter, we're going to be looking over the fixed assets and long-term tangible assets used in normal business operations, such as machinery, and equipment, buildings, land, and land improvements. Okay, all fixed assets except for land should be depreciated over time. There's three factors that we need to determine when we're calculating our depreciation. The first one is the fixed asset's initial cost. The second is the useful life of the asset, and third is the residual value. Okay. So this particular chapter covers a variety of ways to calculate depreciation. Please make sure that you read the chapter before you attempt any of your problems. Okay. In this particular chapter, they explain depreciation may be determined using either the straight line method, the units of activity method, and the double declining balance method. So they go on to explain those three different methods in detail, and we're going to be able to apply what was learned in the chapter to problems related to this. Okay. So there's a lot of information included in this chapter that deals with long-term assets such as patents, copyrights, trademarks, goodwill, intangible assets. There's a lot of information about the depreciation methods for each. It's just a wealth of information. Please make sure that you read it so that way you are familiar with the content. Okay, like every week, I am not going to go over the chapter with you. I am just going to dive into problem solving. Okay, if you have any questions as you're working your homework problems, please do not hesitate to contact me. I am here to help you and provide you as much guidance as possible. So, you can contact me during my office hours, or send me a Blackboard message, an email, a text, whatever works for you. So, you can get your questions resolved and you can be able to complete your assignments. Okay. So, the first exercise that I'm going to work on today is exercise 9.3. Okay. And this problem deals with determining the cost of land. So, it tells you, On-Time Delivery Company acquired an adjacent lot to construct a new warehouse, paying $90,000 in cash and giving a short-term note for $50,000. Legal fees were paid of $1,750. Delinquent taxes assumed were $25,000, and fees paid to remove an old building from the land were $9,000. Materials salvaged from the demolition of the building were sold for $1,000. A contractor was paid $415,000 to construct a new warehouse. They're asking us to determine the cost of the land to be reported on the balance sheet. Now, in your chapter, you are provided with Exhibit 2, which basically breaks down the cost of acquiring the different types of fixed assets, whether it be a building, machinery and equipment, or land. Now, this particular problem deals with land, so we're going to be focusing on land. Okay, so when we're calculating or figuring out the cost of our land, we have to take into account, amongst other things, the purchase price, any sales taxes, any permits from government agencies, any broker's commission, title fees, survey fees, any delinquent real estate taxes, the cost of removing any unwanted buildings, less any salvage value, and any grading and leveling. Okay, so they give you a pretty good overview of what needs to be included to determine the cost of acquiring land. So we're going to start off with the purchase price. Okay, how much did we pay for the land? Well, it says here that you paid $90,000 in cash, and you also have a short-term note for $50,000. Okay, so the purchase price is going to be your $90,000 plus the $50,000 of the note. So you owe the bank $50,000 and you paid $90,000 in cash. So that's let me get my calculator out. That's $90,000. 1, 2, 3 plus 50. That's $140,000. Okay. Okay, so we're going to go through the list of things that they paid when they acquired the land. So they paid $90,000 in cash. They got a note for $50,000. And then they also paid legal fees of $1,750. Okay. Now these are all of my additional costs. So I'm going to put those in the first column and add them together. So I have legal fees, and in legal fees I paid $1,750. Okay. Delinquent taxes. Okay. When you purchase land, you have to pay any taxes that are due. So in this case, we had delinquent taxes of $25,000. Fees were paid to remove an old building from the land, $9,000. So it says here, removing unwanted buildings less any salvage value. Okay, so we paid $9,000 for the demolition of building. Okay. Now this is very important. Material salvage from the demolition of the building were sold for $1,000. We'll make that adjustment later. Okay, and then they let us know that a contractor was paid $415,000 to construct a warehouse. The cost of the warehouse is not associated with the cost of land. Right now we're trying to figuring out that the cost of the land to be reported on the balance sheet. Okay, the land is just the land, the piece of land by itself. Okay, the warehouse has nothing to do with that, so that information we don't have to use it. Okay. So now that I have gone through all of the information, I can go ahead and I can calculate my total costs. Okay. So I'm going to add those three costs together, and that's going to give me $35,750. Well, I can put these up here, and then let me just make this change. I can just put it up here, and then I can calculate my total cost in the bottom. Okay, so the total of those three is $35,750. So now my total cost is going to be my purchase price plus my additional cost of $35,750, and that gives me $175,750. Now it's very important. It says removing unwanted building less any salvage. So if you tore down the building and you were able to get maybe metal from the roof or pieces of wood that are good and you can salvage it, you can sell it on the side, then that's awesome. So it says here that the land cost is the removal, what you pay to remove the building, less any salvage value. So it says here that material salvage from the demolition of the building was $1,000. So it's going to be minus, less. So I'm going to subtract that. Salvage value of materials. Okay. So this is how much I was able to recuperate. I was able to sell those pieces of wood and metal. Okay. So I'm going to subtract that. The salvage value of the materials. Okay. And now I can calculate the cost of land to be reported. So that will be the sum of the $175,750 minus the $1,000. It will give you $174,750. That is how much you're going to book your land for in your company's books. Okay? The land is going to be the purchase price plus legal fees plus delinquent taxes plus the demolition of the building minus the salvage value of materials will give you $174,750. So that is the first exercise that we are covering here, how to calculate or determine the cost of land. The next item we have is exercise 9.7. Okay? Exercise 9.7 deals with depreciation by units of activity. Okay? So it says a diesel-powered tractor with the cost of $120,000 and an estimated residual value of $16,400 is expected to have a useful operating life of 28,000 hours. Okay, 28,000 hours. So you're buying the piece of equipment, this tractor, for $120,000, and after you depreciate it, you think that it's still going to have a value of $16,400. That's a residual value. And you're planning on using this tractor for 28,000 hours. Okay. During April, the tractor was operated 150 hours. They're asking us to determine the depreciation for the month. Okay? So when we're doing the depreciation by units of activity method, the first thing we need to calculate is the depreciation per unit. Okay? The depreciation per unit is your cost minus your residual value over your total estimated units of activity. Okay? So, I don't need this box. No border. Okay. So, we're going to do what the formula says. Okay? So, my cost is 120,000. I'm going to subtract my residual value. My residual value is 16,400. Okay? And I am going to divide by my estimated units of activity, and I estimate that I'm going to use this tractor for 28,000 hours. Okay? So, my depreciation per unit is going to be, okay, 120,123 minus 16,400 divided by 28,000. Okay. That would be 3.7. Okay. So $3.70 is my depreciation per unit. Every hour that I use this tractor, I'm depreciating it $3.70. Okay, that's basically what it's saying. For every hour you use the tractor, the cost of depreciation is $3.70. Okay? So, my depreciation expense. They're asking you to determine the depreciation for the month. Okay? So, my depreciation expense is the depreciation per unit, and we just calculated that up here. My depreciation per unit is 370. Okay? The units of activity. How many units did you use it during the month of April? It says that during April, the tractor was operated for 150 hours. Okay? So, to calculate my depreciation expense, it's going to be the 3.70 times 150 hours. That's going to give me $555 depreciation for the month of April. Okay, so step number 1 is calculate the depreciation per unit, which is the 370. Once you calculate that, you just get your depreciation per unit. You multiply it by the units of activity. In this case, they're telling you that in April, you used the tractor 150 hours. So my depreciation expense is going to be your depreciation per unit times your units of activity per the period, which is 150 hours, and that's going to give you your depreciation expense for that period. Okay? So make sure that you are reading. The textbook provides you with guidance, examples. Please make sure that you follow those as you're trying to attempt your homework. Okay? That was the second problem. Okay? The third problem deals with the disposal of fixed assets. Okay? So you have an asset in your books and you're getting rid of it. Okay? What are you going to do when you get rid of an asset that's sitting in your books? So it says here, equipment acquired on January the 6th at the cost of $375,000 has an estimated useful life of 20 years and an estimated residual value of $25,000. Okay? Letter A. What was the annual amount of depreciation for 1 through 3 years using the straight line method of depreciation? Okay? So to calculate the straight line method, what you basically do here is in this example, you get your initial cost minus your residual value. That's going to give you your depreciable cost. And then once you've got your depreciable cost, you divide it evenly amongst the years. Okay? So, let's do the calculations here. Okay? So, I know that the cost is $375,000. I'm going to subtract the residual value of $25,000. Estimated residual value of $25,000. Okay? And then I'm going to divide by how many years. How many years is this piece of equipment is going to last me? Useful life is 20 years. Okay. Oh, shoot. Doesn't want to get the formula. Let me see. We found a problem. Okay, let me see. Let me try again. So it'll be equals 375,000 minus 25,000. And then you divide that by how many years are we using it? 20 years. There we go. I don't know what it was giving me an error, but there we go. So my depreciation is going to be 17,500. Okay. So I'm going to put here the formula, that way you can keep it. Okay. So it's going to be the cost of the asset, 375,000, minus its depreciation, which is 25,000, divided by the useful life, which is 20 years. Okay. And that's going to give you 17,500. So every year you are going to depreciate this piece of equipment for $17,500. Okay. Under straight line method, it's a very simple way of doing it. It's the same amount every year, regardless of how much you use it or not. It'll be the same amount. It's going to be the same amount for every period. Okay. So it's 17,500 using the straight line method. Okay. It says letter B. What was the book value of the equipment on January 1st of year 4? Okay. So assuming that we use the straight line method, they're asking us to calculate the book value at the beginning of year 4. Okay. So how much did I depreciate years 1 through 3? Years 1 through 3, I depreciated my asset by 52,500. Okay. So how much did this piece of equipment cost me? This piece of equipment cost me 375,000. Okay, that's what it says here. Cost of 375. Okay, less accumulated depreciation. How much have we depreciated it? Well, we depreciated it, this number right here, 52,500. Okay, year 1, year 2, year 3. So they're asking you for the depreciation for the 3 years, 52,500. Okay. So what is the book value? The book value is going to be the equipment cost minus less the accumulated depreciation, and that gives me 322,500. That is how much that piece of equipment is valued in my books. Okay, and that's very important, because if you're wanting to sell this piece of asset, you have to calculate your book value to see how much you're holding that asset in your books for. Okay, that is letter B. Letter C. Assuming that the equipment was sold on January the 3rd of year number 4. So a couple of days after the closing of the year, you sell the equipment for $300,000. They're asking us to journalize the entry to record the sale. So we're getting rid of the asset by selling it for $300,000. Okay, and this is happening on January the 3rd. Okay, so it says here that the equipment was sold year 4 for $300,000. So how much money did we receive? Well, we received $300,000. Okay, let me just put some commas here. Okay. Whenever we get rid of an asset, in this case we're selling the piece of equipment, we need to clear out the accumulated depreciation. Now, accumulated depreciation has a normal balance of a credit. It's a contra asset account. Because I'm wanting to zero it out, I have to do the opposite of a credit, which would be to debit the accumulated depreciation account for the total that we have recorded depreciation. Okay, so we have accumulated depreciation for the equipment. So how much have we depreciated it? Well, we depreciated it 52,500. That's how much was depreciated. Okay. Okay. Now I need to figure out. Okay. Now I'm going to leave a blank there, and okay. I need to remove that piece of equipment from my books. Okay. I no longer have that equipment. I just sold it. Okay. So when we book this equipment, we debited the asset account. Okay. Now that we're getting rid of it, we have to credit it. And the equipment amount will always be the cost. Okay. You always clear the asset by the cost amount. How much did you pay for that? I paid $375. Now I need to clear those $375. Okay. Okay. Now we need to figure out if we have a gain or a loss on this transaction. Did we sell it for more? Did we sell it for less? Okay. So it says here that you sold the equipment for $300,000, but according to our book value, our piece of equipment was worth $322,500. So I'm going to do a little calculation here. So my book value is $322,500. Okay. My sales price is $300,000. Okay. So did you sell it for more or less? So I'm going to get my gain or loss. I don't know what we have. If it's a loss, it'll be a minus. Okay, so I'm going to get my sales price minus my book value. So I've got a loss of $22,500. We have it in our books for $322,500. You sold it for $300,000. You sold it $22,500 less than what we had it in our books for. Okay, so I have a loss. Okay, so I'm going to report that loss. Okay, and if we have a loss, we are going to debit the loss on sale of equipment account. Okay, and we have a loss of $22,500. Okay. Okay, so we have a loss there. We sold the piece of equipment here. What is the piece of equipment? We sold it for less than what we had it in our books for. Okay. Remember, debits need to equal credits. So usually I'm using Excel. I can just highlight them, and then it tells me down here my sum of $375, which is what I have on this side. Okay. So that is requirement C. Requirement D. Assuming that the equipment had been sold on January the 3rd of year 4 for $325,000 instead of $300,000. Journalize the entry to record the sale. Okay. So now in this scenario, letter D, we sold the piece of equipment for $325,000. Okay. And it's happening on January the 3rd. January. Okay. So how much cash did you receive in this transaction? Well, we sold the piece of equipment for $325,000. Okay. Remember, we always have to clear the accumulated depreciation that we have for the corresponding asset. And we had accumulated depreciation of $52,500. I'm going to skip a line, and then I'm going to put my equipment. The equipment was in my books for $375,000. Okay. Now we need to figure out if we have a gain or a loss. Okay. So once again, let me reuse this. For the first transaction, I know that I sold, or my book value is $322,500. I sold this equipment for how much? For $325,000. Okay. So now I can figure out if I have a gain or a loss. Okay. And in this case, I've got a gain of $2,500. Okay. And it's a positive, that's why it's a gain. Okay. So you always get your book value minus your sales price. Okay. And that's going to give you your gain or loss. In a doesn't want the parentheses. Okay. So that is what we did. Okay. So now I know that I've got a $2,500 gain. So if it's a gain, okay, we're going to go ahead and we're going to credit our gain on sale of equipment. Gain on sale of equipment account. Okay. So we had a gain of $2,500. Okay. And if we have a gain, we've credited. Okay. And we just need to make sure that our debits equal our credits. 377,500. 377,500. Very good. So yes, my debits equal my credits. So I'm good there. So I'm going to put a little notation here. The gain is equal to the 325,000 minus the 322,500. And that gave you the 2,500. Okay. So that is exercise 918. It shows you kind of calculate depreciation. Well, in this case, the depreciation for the 3 years. Okay. And then calculate the book value. And then figure out the entries when you're actually selling the assets. Okay. If you're selling it for a loss or if you're selling it for a gain. Okay. So the last problem that I'm going to go over is going to be on your test. This is problem 9-2. Okay. And I selected this problem because it compares the 3 depreciation methods. Okay. So it says Dexter Industries purchased packaging equipment on January the 8th for $72,000. The equipment was expected to have a useful life of 3 years, or 18,000 operating hours, and a residual value of 4,500. The equipment was used for 7,600 hours during year 1, 6,000 hours in year 2, and 4,400 hours in year 3. Okay. Instructions. Determine the amount of depreciation expense for the 3 years ending December 31st by the straight line method, the units of activity method, and the double declining balance method. Also determine the total depreciation expense for the 3 years by each method. The following columnar headings are suggested for recording the depreciation expense account. Then they give us a setup. Okay. So let's figure it out. This is the setup that they want. The year, straight line, units of activity, double declining. I'm going to be doing my calculations below and then transferring the information over to the top. Okay. So the first thing we're doing is the straight line method. Okay. The straight line method is your cost minus your residual value divided by your useful life. Okay. So let me move this over here. So the cost of this asset is $72,000 less the residual value. We have a residual value of 4,500. And then useful life, this piece of equipment should last us 3 years. Okay. So let's see what that gives us. It'll be 72,123 minus 4,500 times, I don't know what I'm doing. It's 72,000 minus 4,500 divided by 3 years. So that would give me an annual depreciation of 22,500 per year. Okay. So using the straight line method, it's your cost minus your residual value divided by useful life. The cost is 72,000 minus the residual value of 4,500 divided by a useful life of 3 years. That's going to give me what is it? The depreciation expense of 22,500 per year. Okay, so now that I know that, I can fill in the top part. It will be the same dollar amount for all 3 years. So what the straight line method does, it basically divides the cost of depreciation over the useful life evenly. Okay, so every year you'll have the same amount of depreciation. Okay, equals the sum of those three. Okay, now the units of activity method. Okay, here we apply actual usage. Okay, so under the straight line method, we basically estimate, and whether you use it more one month or less the other month, you're still going to get charged $22,500 depreciation expense. Now the units of activity method aligns more to actual usage. So in this case, they give you the usage during the year, which is year 1, 6,000 hours. Let me see. Okay, year 1, 7,600 hours, year 2, 6,000 hours, and year 3, 4,400 hours. Okay, so the first thing we need to do is calculate the units of activity method. Okay, so this is your cost minus your residual value divided by the units of activity. Okay, so for year number 1, I'm going to get my cost, which is 75,000, minus my residual value, and my residual value is 4,500. Okay, and I'm going to divide by the, I'm putting in the wrong cell. It should be up here. Let me insert another row. Okay, so the cost is 70, how much? 72,000. And we had a residual value of 4,500. Okay, residual value 4,500. And then I'm going to divide by the units of activity. And according to the problem, we're going to have a useful life of 3 years or 18,000 operating hours. So we're going to divide that by the 18,000 hours. Okay, and we get, let me see what we get. Okay, so we're going to get the 72,000 minus the 4,500 divided by the number of hours, which is 18,000. That gives me $375 per unit. This is per hour, because over here it says that it's expecting to have 18,000 operating hours. Okay, so now that I know that my depreciation expense for this piece of equipment is $3.75 per hour for operating hour, I can calculate my year 1, year 2, year 3. Okay, so we're gonna get our depreciation per unit. Okay, my depreciation per unit will be the $375. Okay, and I'm gonna copy that over for year 1, 2, and 3. It's the same. Copy, paste. I don't know. Copy, paste special. Values. Okay. So I've calculated my units of activity. Okay, of 3.75 per hour. Okay, that's my depreciation cost. Okay, so units of activity. The problem says that year 1 you had 7,600, year 2 you had 6,000, and year 3 you had 4,400 hours. So we're going to multiply our depreciation per unit raised times our activity. Okay, and our activity is 7,600 hours. Okay, 6,000 hours, and 4,400 hours. Okay. And then if you multiply the depreciation per unit times the actual units of activity, you get your totals. Okay. So we have 28,500 for year 1 because it was the one that had the highest activity, 7,600. And then 22,500 for year 2, and then 16,500 for year 3. And this aligns to actual usage. Whatever the piece of equipment was used for, they kept track of the hours used, and we were able to calculate our cost, our total cost. Okay. So now that we've figured that out, we can just copy and paste these 3 numbers over here. Okay, now we're going to move on to the double declining balance method. That really increases the depreciation towards the beginning of the period and then trickles down or decreases the following years. Okay, so it's a very aggressive form of depreciation. Okay, so the double declining balance method. Okay, for that in your textbook they explain 3 steps: step 1, step 2, step 3. Okay, so step 1 says to determine the straight line percentage using the expected useful life. Okay, so determine the straight line percentage using the expected useful life. So I know that the useful life of this piece of equipment is 3 years. Useful life, 3 years. Okay, so what I'm going to do here is I know I'm going to depreciate. It says determine the straight line percentage using the expected useful life. I'm going to 1 over 3 years. And that's going to give me my depreciation rate. Okay, so it's going to be 1 over 3. Okay. Then step 2 says determine the double declining balance rate by multiplying the straight line rate by 2. So I'm going to get whatever I got on my depreciation rate for step 1, and I'm going to multiply it by 2. Okay, I'm going to move over here. Okay, so all I did was double on step number 2. All I did is I doubled my original depreciation rate. Okay, and you're going to get the number of years that it mentions in the problem. Okay, now step number 3, compute the depreciation expense by multiplying the double declining balance rate from step 2 times the book value of the asset. Okay, so we're going to get whatever we got in step 2, and we're going to multiply it times the value of the asset, and the asset cost me $72,000. Okay, what did I do? Let me see. Yes, that's correct. I'm just gonna copy it over here. Okay, so step number 1, you're going to divide right here, determine the straight line percentage using the expected useful life. Then you double it. Whatever you get there, you double it. Okay, and that gives you 0.0666. Once you get that, then you multiply that double rate times the cost. Okay, 0.66666667 times the cost, which was $72,000. Now it's very important when you're doing your calculations that you don't clear out your calculator, because if not, your numbers are not going to be correct. So for example, here I did 1 over 3 years. Sorry about that. 1 over 3. Once I have that number in my calculator, I double it. So I just do times 2, and then that gives me 0.66666. Once I've got that number, then I multiply it by my what was this amount? The cost of $72,000. Okay, and that gives you the 48,000. Okay, if you enter these numbers manually, you might not have enough the correct digits or whatever the case might be, and it'll throw off your ending amount here. So be very careful. Okay, so that is what happened on year 1. Year 1, we are going to depreciate it $48,000. Okay, let me put here year 1. That way we know. So this is how we calculated the amount of depreciation for year number 1, 48,000. Okay. Now, for year 2, it's going to be a little bit more complicated. You're going to get your year 2. Okay. You're going to get your initial cost of the equipment. Okay. The initial cost of the equipment was 72,000. Okay. You are going to subtract the depreciation from year number 1, which is 48,000. Okay. And you're going to multiply by that rate right there. Okay. You're going to multiply it by the 0.666666667. Okay. You can either use let me put it here. You can use decimal or percentage. So what they did is they broke out 3 years. You know, how can I explain this? To get the straight line, how many years are you gonna have this asset? 3 years, so you're gonna get an annual 1/3. Okay. So you can use either a decimal or a percentage. 0.66667 is 2/3. Okay, whatever works for you. Okay, and that's what you're gonna do. That's gonna be the formula. So let's see what we get. Let me put this down here. Okay. So let's put that into our calculator here. It's gonna be equal the 72,000 minus the 48,000 of depreciation from the first year times my rate, my double rate. My double rate is that one, okay? I don't know why I'm getting so many issues with my Excel. Let me try it again. Well, I've been having issues with my computer in general, but let's see. So it'll be equals 72,000 minus my depreciation from the first year, which is that 48,000, okay, times the double rate. There we go, and it gives me $16,000. Okay, so my depreciation for the second year is $16,000. So it'll be the 72,000 from the original cost minus 48,000, which is from your depreciation for year number 1. We want to deduct that depreciation that had already taken place. Okay, right there. Okay, and then you're always going to multiply by that double rate. Okay, that's the double rate that we calculated. Okay. Okay, so now for year number 2, it's going to be 16,000. Now, the last year is usually a little bit tricky, okay, because we need to depreciate all the way up to the salvage value. Okay. And this problem, we had a salvage or a residual value of $4,500. Okay, so I know that I've depreciated it 72,000. Okay, the first year, and then I depreciated it 16,000 the second year, right here. So the first, I'm sorry, I forgot the first year. So our cost was 72,000. I depreciated it 48,000 year number 1 minus 16,000 year number 2. Okay. Now let's figure this out. Okay. 72,000, 1, 2, 3, minus 48, 1, 2, 3, minus 16. Okay. That gives me $8,000 balance remaining. But I know that I have a useful life, or a residual value, of $4,500. So I'm going to subtract those $4,500 because that's my balance that needs to be outstanding. So that means that in year number 3, I'm only going to depreciate it $3,500. Okay, so let's explain that again. When you're looking at the double declining balance method, it's basically double the straight line method rate. Okay, so first you get the straight line method, and then you get the double rate. Okay, so this is 1/3, and then this is 2/3 basically. Okay, So the first year, very aggressive, you're going to depreciate at 48,000. For year number 2, what you're going to do is you're going to get your cost minus the depreciation for year number 1 times the double rate, which is a 0.666 or 2/3, whatever works for you. And that gives you 16,000. Okay? Now for year number 3, or the last year, it could be 20 years. When you're doing the 20th year, you need to go back and say, okay, this particular equipment cost me 72,000. I depreciated at 48,000 year 1, 16,000 year 2. Okay? Now I know that I have a residual value of $4,500. Okay? I'm going to subtract my residual value. Okay? Residual value. Okay? And then that is going to give me the amount that we need to have for depreciation for that year. So it's 72,000 minus 48,000. That's year 1. Let me put just here year 1. Okay. 16,000 is the depreciation for year 2 minus the residual value. Okay. And then that will let us know how much depreciation we're going to have for year 3. Remember, we have to depreciate and stop at $4,500. So that's going to be 72,000 minus 48,000, my depreciation from year 1, minus my depreciation, 16,000, year number 2, right here, minus my residual value of 4,500. So that means that this year, year number 3, I am going to depreciate it $3,500. Okay? So if you notice, extremely large amount of depreciation year number 1. Year number 2, 16,000. Year number 3, very low at 3,500. So I'm going to copy these 3 numbers and I'm going to paste them over here. Okay. Okay. So now I've completed my table. I've got all of my calculations down here. This is my straight line, 22,500. That's my total. Units of activity method. We calculated the units of activity per hour. We multiplied it by the units of activity to get our depreciation expense for each of the years based on actual activity. So then this amount gives me, how much does it give me? 67,500. Okay. And then the third method, double declining balance, that's a little bit more trickier. Your textbook has an example and steps. Just know that you're going to get the number of years, 1 divided by the number of years to get your initial rate, double that rate, and then once you get that rate calculated, then multiply it times your cost. Okay? Make sure that if you're using a calculator, you don't delete or you don't round your calculations. You leave them in the calculator and then rerun the next calculation. Like in this case, let me show you. So, okay, 1/3, you enter it, that gives you 0.33. Now I need to double it. That gives me 0.666. Then I need to multiply by 72. And then it gives me 48,000. You see, I never delete my calculations. I just keep on using the numbers, okay? That way you don't have any rounding issues, okay? So, let me see what the total is here. So if you notice, regardless, oh, I forgot to enter an amount. That was $3,500 right here. So regardless of the method that you use, your depreciation expense is going to be at the end of the 3 years, 67,500. Okay? And why 67,500? Because we are not depreciating it all the way to 0. We have a residual value. So the 67,500 plus my residual value of 4,500, that gives me my cost of 72,000. So the residual value is just saying, you know what, at the end of 3 years, we're going to have this piece of equipment and it's still going to have a value of $4,500 on it. Okay. All of the places that I've worked before, we usually depreciate to 0. We don't usually carry a residual value. Okay. But we do need to know that it's out there, it's available. So that way you become familiar. So those are the 3 calculations using the straight line, units of activity, and double declining balance method. You have to complete the table and compare. That is requirement 1. Requirement 2. What method yields the highest depreciation expense for year 1? So let's go to the table. So which of these methods give you the highest depreciation year 1? So for year number 1, the one that gives me the highest depreciation is the double declining balance method. That gives me $48,000. Okay, so I'm going to just type it out here. For requirement 2, the double declining, I can't spell. Here we go. The double declining balance method yields the most depreciation. And I misspelled depreciation, guys. Depreciation. Okay. For year 1 of $48,000. Okay. So if we were to compare straight line versus units of activity versus double declining, in year number 1, the highest one is the double declining. So that is number 2. Okay. Number 3, what method yields the most depreciation over the 3-year life of the equipment? Okay. And if you notice, over the 3 years, all of the methods should yield you the same amount. It doesn't matter what method you use. It's just a matter of how you're distributing the depreciation over the 3 years. You're going to depreciate it the same amount. The only things that change are the method. One of them is the same amount every year. The other one is based on actual usage. And the other one is very aggressive. Most of the depreciation is done at the beginning and then it dwindles down. Okay? So, for number 3. Over the 3-year period, over the 3-year life, let's make it more professional, of the equipment, all 3 depreciation methods yield the same total depreciation of $67,500, which is the cost of the equipment of $72,000 less the residual value of $4,500. If you don't have, or when you're doing your calculations, if you don't get the same amount for the 3, then you made a mistake somewhere. Okay, the most confusing part that I've had students had issues with is with the double declining balance method, and it usually is in the last year. Okay, in the last year when you're calculating your depreciation for the last year when you're doing the double declining balance method, you have to get the cost minus the depreciation for the prior years, year 1 and year 2, deduct the residual value, and that will let you know, it's kind of like a plug, how much you have to depreciate that specific year. So be very careful when you're doing your double declining balance method that you carefully analyze the information presented. Okay, this problem is going to be on your test. Okay, that's why I took the time to cover it. It's a little bit challenging, but I've gone over it. All of my calculations are included. If you have questions, don't hesitate to contact me. Please organize your time. That way you are not struggling to complete your assignments on Sunday at 11 p.m. Make sure that you dedicate enough time during the week to complete your assignments. So that is basically it for this lecture. I want to wish you all good luck on your assignments, and until next time, thank you.